decent sunny Friday afternoon in Southwest Florida. My son and his wife are down, and I think everybody's getting ready to head for the pool. Of course, the granddaughter is here, one of the world's two most beautiful granddaughters, in fact, and I believe she's going to go swimming as well. Do a little floating around the pool this afternoon. Now, I'm going to spend a few more minutes in here kind of talking about the week that we've had, and it's been an interesting week. We tried to rally early in the week because, the theory was that the Fed would slow down interest rate hikes because we were starting to see some signs of economic weakness. Jerome Powell has, disabused everybody of that notion. Inflation is job one, mission one. Yesterday, we saw Esther George of the Kansas City Fed, the president of the Kansas City Fed, come out and say, look, we're fighting inflation. If the market doesn't like it, basically, that's too bad. The Fed put that has been in place pretty much since the internet bubble blew up has been eliminated. It has expired worthless for all intents and purposes. The Fed is not going to consider backstopping stock prices as one of its missions when it's really appeared at times to have done exactly that for most of the last 20 years. They made the critical mistake of letting inflation run hot, and again, for the first time since Arthur Burns back in 1972, and they've discovered just how difficult it is to get that dragon back into the cage. Just like Paul Volcker didn't care, they cannot care at the Fed today. They have to get the dragon back into the cage before it does severe damage to the U.S. economy. One of the reasons for the selling right now is the rising rates and the very real fear that this could tip the economy into a recession sometime in 2023. As it sits right now, I would say the odds of that happening are pretty good, but the economy is in better shape than I think the media wants to give it credit for. Unemployment's extremely low. Wages are rising. People are wealthier than they were before the pandemic. So I think we can weather a smallish depression, which is all that I would see happening at this point in time because, the consumer is in pretty good shape. Lots been made of, oh my goodness, the debt levels are going up. And they did. They went up by a whole bunch in April. Here's the thing. Debt service as a percent of household income is actually at one of the lower readings of the last 40 years. So is total financial obligation, which includes your debt, plus the stuff that's, related to your debt, automobile leases, homeowners insurance, property insurance, that type of thing. It's only at 15% of total income. And again, one of the lowest rate readings in the past 40 years. So do we have more debt in absolute terms? Yes. But in absolute terms, we also have more stuff and we have higher incomes as a whole. That's not true for every American. Obviously, the bottom end of the economic strata is suffering and suffering very badly under this. One of these days, I'll do a video on just that topic. I do have some very strong thoughts, but generally speaking, most folks in the United States, say at least 80% of us, are doing pretty well. Debt service is not that big an issue. Certainly not as big as the headlines have been. So I don't think we'll have a massive depression or recession. There's not a lot of home equity loans out there. There's not a lot of garbage lending going on. 11 trillion of the 15 trillion in total consumer debt is in fact mortgage debt. And I don't have to tell you, nobody's written any garbage mortgages in since 2009, basically. So I think it's a high quality mortgage portfolio. And 95% or more of that gets paid as agreed or refinanced at some point, but is not an issue or a problem for the U.S. economy. Now, we have been telling you all year, or I have been telling you to be more specific all year, to stay away from the big stock indexes, okay, to just avoid like the plague, the hot story growth stocks that have no profits but traded at massive price to sales valuations. They have been a problem all year. They're going to continue to be a problem. Shockingly, there's still a bunch of them. That's how elevated we were. We've had companies that, they've dropped in half, but they've only gone from 100 times sales to 50 times sales. So real problem still there. Market's still pretty close to 25 times earnings. It's heading back, for a more realistic place. We probably can get down to as low as, I'm going to say 3,300 on the S&P 500 and be back to a fair value price to earnings ratio that's kind of in line with the historical average market PE ratio. We'll see, if we get that far down. It's not as far down today as it was a few days ago with the S&P trading at 3840. Market did try to rally earlier today, which is up sharply at the open, immediately dropped off. We've had a 100-point range in the S&P 500, over 130 points actually in the S&P 500. And we've had a range of about 1,000 points on the Dow Jones Industrial Average today. So we tried to rally, failed miserably. And currently, as we're doing this, the Dow's down about 413 points with 60 points off in the S&P 500. So we're probably going to close with another negative here on Friday to give us a whole interesting range of nasty, dirty headlines going into the weekend. We did see high yield credit spreads have crossed over the 10-year median this week. Now, we generally try to base any permanent decisions off where they are at the end of the month. We'll see where that is. But, we're in bear market territory now. And now what we're going to be looking for is that massive buying opportunity where we're going to be starting to get interested in buying larger companies and getting involved with the indexes and some of the better tech companies. We're not there yet. When we get 2 standard deviations above the mean, which is a little over 6.5% in high yield credit spreads right now, that's a pretty big spread. Then you're going to look for it to start to show signs of topping out. Okay, that could happen at 7.5. In an extreme sell-off. You could see that happen, at over 1,000 basis points. We've been there before a couple of times, 2001 and 2008, standing out in my mind. You want to see it move up and then start to pull back. And that, most of the time, when you're above the 10-year mean and you see the credit spread starting to fall, that's been a really good time to be a buyer of stocks. You may be early, but the 3 to 5 year results are probably going to be really good when you hold off buying until that point in time, because the fear has peaked. Some optimism is starting to come back into the market. There is some buying activity on the part of institutions in high yield markets that are forcing the rates back towards where less risky securities are trading. So there is some confidence starting to return. Generally speaking, valuations have been depressed because markets have been falling, and you're getting in at a pretty good time. Love to claim credit for all of this research. I always give credit where due. Dan Rasmussen and his team at Verbdad Advisors were the ones that I stole this idea from. They're brilliant people. I read everything that they put out. I don't always agree with it and steal it, but I do steal a lot of it from those guys. So keeping an eye on high yield credit spreads. We're watching the slope of the yield curve to see what that's telling us about the likelihood of a recession. It is still very flat. I do expect to see it steepen out at some point here in 2022. Now, looking at charts, I'm not a technician. I don't even play one on TV, but I do know how to read a chart. I did read the books on it, and I don't see anything that's going to bring technical buying into this market yet. It looks like a free fall to me. You're not seeing any signs of a choppy bottom or build a base. Nothing, you look at the S&P 500, even on something like relative strength, it's not really oversold yet. So we probably have some more downside. I think that 3,300 target could easily come into play before this is over. Remember, we started from very elevated levels. Generally speaking, stocks do not do well when the Fed is raising rates. Guys, the Fed's just getting started. They raised in May. They're going to raise again in June. We're a long way from this being over. And Jerome Powell has made it clear. We're fighting inflation here. Okay, we're not worried about stimulating the economy. We're not worried about protecting the market. We are fighting inflation. He thinks the economy is in, again, as I said, better shape than the media is giving it credit for, and it can withstand the actions he's going to have to take to rein in inflation. Will he be proven right? Time will tell that particular story, but we do know from all the historical evidence, and I heard this the first time back in the 1980s from Marty Zweig, when the Fed is raising rates, it's generally not a great time to own large cap stocks or to be an aggressive buyer of stocks. So we're going to stick around, guys. We're staying into the real super small part of the world, we're looking at small banks with big dividend yields still. We've got a good one for you today I think you're going to like. And of course, the banks that we put in banking on profits. Now, I'm just going to tell you guys, we have for the first time in a long time, thanks to falling prices that have created opportunities and the fact that some of our favorite banks have pulled back some. We're doing well. We're crushing the market. We're down barely 2% for the year when the markets are now flirting with being down 20. I'll take that 6 days a week and twice on Sunday. That's an outstanding result. And I expect to finish the year solidly in the black on the heels of a lot more takeover activity in the portfolio. But again, story for another day. That is really where we've got our focus. We've been adding banks to the portfolio. We've got a 20 stock buy list for the first time in a long time. We're avoiding all the indexes. We don't own any of that stuff. We've been talking about energy all year long, particularly MLPs. We gave the Amplify a couple of weeks ago that I think is going to end up doing extraordinarily well. The MLPs that we were buying last year and earlier this year are all doing extremely well. The asset values have appreciated, and we are just seeing them throw off tons of cash. And that is going to continue, folks. We have a supply-demand imbalance in the energy markets. If we start investing today heavily in carbon-based energy production, we can probably solve this supply-demand issue in 2 to 3 years. We're not doing that. The policy has been we're going to accelerate and invest in more renewables. That ain't going to work. It's going to take a decade at least for that to make a meaningful difference in what we're seeing in oil and gas prices right now. We just can't ramp it up that fast. It's not that I'm not a fan of renewables. It's that we don't have enough rare earth metals. We do not have enough copper. We don't produce much of either of those here in the United States, so we've got to import every single bit of it. And a lot of it's coming from places that, folks, to be honest, just don't like us very much. China has most of the rare earths on the planet, either within their borders or tied up on long-term contracts. And I don't think they're going to share with us. So that's going to be a problem for renewables and electric cars alike. So the focus needs to shift back to production of carbon-based fuels, oil and gas. We haven't done it yet. There's no inclination that the administration is going to do it. So we may be struggling with higher energy prices for a while to come. And not good news for your pocketbook. I understand that. But it is great news for some of the smaller energy companies that I've been talking to you about, and for the master limited partnerships that own a whole bunch of, oil and gas infrastructure, pipeline storage facilities, terminals, that type of thing. Now, it's also, we're seeing a pullback, not just in stocks, guys, but some of my favorite real estate investment trusts have been pulling back. And now doing just a little bit of buying here. One of my favorite names in industrial real estate. Industrial real estate, obviously, is warehouse space. Okay, we've talked about it a lot. You're seeing a rebuild of the supply chain all over the country. Just-in-time ordering was nice, but when you have a crisis, it doesn't work. And we just figured that out in 2020. We're going to see more demand for local warehouse space. We're already seeing shortages in some parts of the country. And of course, you had the dramatic increase in e-commerce for just about everything in 2020, which is also creating massive demand for warehouse space. Now, one of my favorites before the pandemic, before everything ran up, is Plymouth Industrial, symbols PLYM. Plymouth has a unique approach. They're not buying the A-rated properties in the most vibrant and growing cities. They're not in the major urban markets. They are looking to buy B-level industrial properties in smaller cities and towns that have manufacturing, industrial, and shipping centers. For instance, they have a bunch of facilities in Memphis. Why Memphis? It's where FedEx is based, and so it's a major U.S. shipping center. They have a lot in Indianapolis, which a lot of truck traffic flows through there. It's been a shipping center and trucking center for some time. They've got some in the South. They are primarily in the Midwest, guys. They've got some in the South in Memphis, and as you work your way down, and there's a couple up in New England and New York, and one right in Pennsylvania. Primary focus is on the Midwest, and that's where they've been looking to make deals and to make acquisitions. I love the focus on B class in secondary cities. And I'll tell you, guys, even in secondary smaller cities, right? E-commerce is still a thing. There's still lots of shipping. There's still going to need to be local warehouse space. A lot of the areas where they're doing business are manufacturing centers. And guys, manufacturing in the United States may have leveled off, but we're getting ready to see a lot of the global supply chain for things like semiconductors going to Cleveland, for instance, and in the desert down in Arizona, for pharmaceuticals, and a lot of the things that we've let slip offshore as far as the supply chain. And I've now realized there's like national security issues involved in this stuff, and it's important to have that supply chain back home. That's going to create some manufacturing demand, and I think it's going to be real good for some of these cities and towns where Plymouth does business. So pretty excited about this REIT. It's got a 4.53% dividend. It was just raised back in April, and the safest dividend, as you know, is usually one that's just been raised. So super bullish on industrial real estate. Now, I'm only buying a little bit here because the one thing that I have noticed is even as REIT prices have been falling, there has not been much of a pickup in insider buying in real estate investment trusts. Now, management does already own a good stake in this particular REIT, so that makes you think that that's why they're not buying or adding just yet. But when I start to see aggressive, widespread buying in the real estate investment trust sector of the market, then I'll get even more bullish on some of these industrial and other REITs that I like a whole lot. So anyway, that's one. Now my bank, I think you're going to like this one. Sierra Bank Corp, the symbol's BSRR. This is Bank of the Sierras. They are located in the booming metropolis of Porterville, California, which is in the Sierras, pretty much between Fresno and Bakersfield. I have been there. It's a small but growing town. They've acquired a lot of the smaller towns around them and kind of grown that way over the years. They have 36 branches, $3.2 billion in total assets. It's a fantastic pricing point, let's call it, for somebody that wants to expand into that area of California. A lot of defense bases, a lot of stuff going on in the Sierra Mountain and Sierra regions of California, and they do have a presence over towards some of the coastal markets. So nice little bank. I've met some members of the board and the CEO at various banking conferences. They're smart people. They know what they're doing. The stock has been off with a lot of the market. They are doing about 60% commercial real estate, both owner and non-owner occupied, maybe 20% single family. In spite of the heavy agricultural influence in the San Joaquin Valley region where they operate, we're not seeing a lot of farmland loans. It's less than 5% that's out there in farmland and agricultural loans. So they've not been aggressive about courting that particular type of business. That is a specialty business. You really have to know what you're doing. They're aware of that. They've done just a little bit. Non-performing assets are just 0.89% of total assets. Lots of capital with an almost 12 equity to asset ratio. Guys, this thing's trading at just 8 times earnings, just 1.07 times book, and yielding currently 4.36%. It's a great, well-run little bank, probably down as much as it's going to go down. 8 times earnings for this bank is just what I'll go ahead and call a stupid price. Should be trading a lot higher. As the market recovers, I expect this thing to shoot higher. Higher interest rates should be a plus, not a negative for the bottom line. So we could see some dividend increases as profits continue to trend higher over the next couple of years. So there we have it, guys. It's a wrap. Selling, I don't think it's going away anytime soon. We're going to see some of those classic bear market rip your face off rallies. We had, it started in 2010. We had almost a 12-year bull run. Valuations have gotten to one of the highest levels they have ever been, whether you compare that to earnings, to cash flows, to dividends, to the gross domestic product of the United States. We got to the point where the price was too high. Now we're going to get back down to where the price is realistic, and probably maybe even a little bit of a discount to the point of realistic, because we do tend to overshoot on both sides. We'll see how it plays out. I'm not going to make any firm predictions. I'll continue to let credit spreads and interest rate markets kind of give me an idea of what's going to happen in the market. In the meantime, I'm going to keep my head down, keep buying banks with low price to earnings ratios and high dividend yields, and of course, in banking and profits, we're going to focus almost entirely, well, in fact, entirely on smaller banks trading at big discounts to tangible book value with solid loan books and excellent capital structure where they're bulletproof pretty much and can handle anything the economy throws at them. And they are perfectly situated to be a takeover target either this year or next. Remember, we've never close to losing trade in that portfolio. We usually exit via takeover. It's been a wildly successful investing opportunity for those that took advantage of it. You can go to marketfy.com today and sign up for Banking on Profits. It's only $1,000 a year, and I promise you, you will make up for that by the end of the year. If you're using our strategy, you'd be down 2. If you've been buying big name, exciting tech stocks, well, you're probably down about 40. So at $1,000, it's a bargain. Get over there, sign up today. I'm Tim Melvin. I'm going to go see what kind of madness is going on out here at my pool, and I will talk to you at some point next week. Thanks for watching.